Hello Cans people, back to our Finance Act 2024 Personal Tax Practice paper. So let's have a look. Task 6 onwards, we'll do 6 and 10 because 7, 8 and 9 are linked, so put them together in one video. So a bit of knowledge on tax planning. So you're thinking about switching to an electric car. Employer as a company, lower taxable benefit, that's right, because it's only going to be the 2%, and there's no petrol engine car, except the really, well actually, is there? Okay. Strictly speaking, oh, we'd have to go back up to the rates. What does it mean? Nil, nil, no, 1, 2, strictly speaking, I'm sure there is a hybrid that is in that bracket, and actually could be the same, but well, by and large we think they really mean yes. No taxable benefit for electricity. Yes, it's too impossible to check how much electricity is going into a car, so they don't give it anything like the 27,800 fixed amount, because you really don't know how much is going in at the workplace, at home, or at the service station or somewhere. Transfer money to a husband, wife or civil partner, so read carefully. Implications for inheritance tax, but not for capital gains tax. But no, it will have issues for capital gains tax. So, because it means you bought something off your partner, but it's got to be valued then for capital gains, not at the amount paid, but at the cost the original husband or wife bought it for. So there is an implication. And then we've got another tax planning one, sort of common type question. We've got Richard earning 29,000, so he's a basic rate taxpayer with quite a bit left in his band. And Bev's employment, she's into the higher. There's no other mentions of anything that would make her band higher. So if they move it into Richard's name less than the wife's, okay, let's just do the sums. So first of all, remember, it's not 10,000. They both are going to get £500 off. So I won't show that as a formula. I'll just put that one straight in. So Richard, put an R there, would pay that much, and Bev would pay gets the same allowance, of course. And then all we've got to do is and we've got our answer. Nice easy marks if you can do it. Perfectly legal, perfectly ethical, well within ethical framework. It's called tax planning as opposed to avoidance. John has total income 125,000 a year, so he's an additional rate payer. What would his allowance to change to? Okay, I can think of 3 completely different ways of dealing with this. First one, okay, present. So 25,000 over 2 is 12,500. So at the moment he's got a personal allowance of 70 left. So more than one way of working this one out. This question, this is the simplest way. And then what would happen to the 8,000? We would divide by 80 times 100. So that's 10,000, and you lose it at the rate of £2 per pound. He's going to save it at the rate of £1 for every £2. So he's going to get saved 5,000. So he's got his 70, and now he's got another 5,000. So fine. You could alternatively do a much longer calculation where you work out what his new band is, work out the 37,700 goes up to etc, etc. But sometimes a bit of numerical skills help. And now we've got Roger, diesel tax car, not RDE2 compliance, and gets all fuel for the tax year. List price 25,000, car benefited 28,000. He's higher rate taxpayer. Doesn't actually make any difference to the question. Fuel doesn't. Neither fuel or the scale charge is related to whether you're higher or basic rate. That's just there to make you think. So changes to a petrol model, the same list price. He's going to save the 4%. So again, we could work it out the long way, we could work it out the short way. So, okay, let's just show the full workings out and then I'll show you the short way. So at the moment, 28% of 25,000 and then 28% it's not right, 27, that's better. So that's the current. Add those two together. And then if we do equals 24%, you would pay that. We could actually have done a slightly different way. Let's work the answer out anyway. So equals L 17 2112. So we could actually also do 4% times what was done there, 27. Missed one off. Do it that way as well. So you could do 4% of 25,000 plus 27,800. Depends how happy you are. Even better, do it the one way and then do it the other way. Always good to check your answers a different way. So on to task 10, because we're going to treat 7, 8 and 9 in a separate video. They're all the capital gains tax stuff, so theory and numbers. Must admit, I'm not a big fan of some of these questions. Okay, read carefully. So these are CLTs. It says unconnected individuals. I'll put in the question marks because actually the first one is about John and his wife who would be connected. However, potentially exempt transfers. So in other words, they might be, assuming that the annual exempt amounts were current. Well, okay, let's have a think. Well, actually, all that's going to happen is it's going to be added into the estate and taken off. They're both got nil rate bands. So 0. Now this one is dubious. The charity has to be on the list that you can look up on HMRC. The publisher says 0. However, Oxfam parent isn't the UK, in which case actually it would be all the 8,000. But there is obviously Oxfam UK, and every single Oxfam shop's a separate charity by itself sometimes. So okay, and then we'll worry about this one. Okay, this one is 34,000. Why? Because you've got to remember that you can donate or use 2 lots of 3,000 previous year and the current year, and obviously nothing's been utilised. That's why that wording is there for this question. Then we need to know a bit of basic facts on inheritance tax. Resident but not domiciled. Nothing in the guide to help you on this. Let's just double check what's in the inheritance tax section in the reference material. The small gaps, the tapering relief, the rates are there. That's it. So you've got to know the rules on domiciled people and resident people. And residents, you do not have to pay on anything from worldwide earnings, but if you were domiciled, you would. On inheritance tax, potentially exempt transfer will be exempt if it, that's the taper rule. Live for 7 years after you've given any amount of money away, and it's free of inheritance tax. Donation to a charity, exempt transfer whether made during, that's okay, although it really should say a UK charity, but I wouldn't worry about that too much in the exam. Assume any charity. And then the last bit of the last task, although we're going to go back and do 7, 8 and 9 in a bit. They're married, utilised all his nil rate band. Now it wouldn't have been £325,000 in the past, however we treat it as if it is now. Sally died in 25, so the estate 750,000, a home valued at 250,000. No lifetime transfer, so we do need the guide a little bit just to remind ourselves of the residents being 175,000. And now we need to do some sums. Again, I would suspect requires a little bit of work on a bit of paper. So what have we got? So he's used all his nil rate band, but none of his residents. In fact, it didn't exist then, but in some questions, but that's okay. But then it doesn't actually make any difference which way round this one would be. That's the 250,000. You could use 175,000 of hers and 75,000 of his. It's just going to clear the £250,000. So that leaves £500,000. He's used hers. So 250,000. Read the question right. No lifetime transfers. 750,000. What would be the 750,000 minus nil rate band and resident. Oh, that's how much would be left. But it's not asking for that. It's asking for, so it's not asking for what you'd expect it, because then you'd be paying the 40% on that. It's asking you the total amount of nil rate band and residence that can be deducted in the calculation. So that's actually the 250,000 plus 325. Answer the right question, because that's 575. Not the question that you would have been expecting.